Invite Dehn of Ashmore for his take on the last 50 days that we've seen. Jan, thank you so much for joining us. Today is the last day of India's currency change. Has it left the economy more vulnerable, or is this only a passing phase according to you?
No, I think it has not left the Indian economy extremely vulnerable. It's been a temporary shock. It's not been executed perhaps as smoothly and as painlessly as expected. But at the end of the day, this is very much a temporary, transitory aberration, and the Indian economy will come out of this without any lasting damage, and probably coming out of this ultimately in a stronger place than where it went in. So I think it's quite important to look beyond the demonetization process, because the underlying fundamentals in the Indian economy remain very solid, and there's plenty of grounds to be optimistic about India going into 2017.
That point is taken, but that's not how the FIs have seen it, Jan. Since the 8th of November, FIs have sold off from all emerging markets because of Trump, but they have deserted India a little more. Do you see that tide turning anytime soon?
Yes, I'm sure it will. Markets tend to get nervous when there are disruptions and uncertainties, and certainly the demonetization process in India and Trump's election were both major sources of uncertainty. They were quite unexpected events, and the market has been struggling, in fact, a little bit trying to process these two events. But I think time will show that neither Trump nor demonetization will have any serious adverse fundamental implications for India in particular. And so I think investors should view the underperformance that we've seen in Indian assets as an opportunity to add to exposures.
Okay, that's interesting. So do you find Indian markets attractive at current levels, since you are recommending investors to use this as an opportunity?
Yes, I do. And I like them actually, both from the equity market and from the fixed income perspective. I think the demonetization process will have will ultimately lead to lower inflation in the Indian economy and more easing from the central bank, and that'll support bonds. While I think the economy is going to rebound in the course of 2017, and that should be supportive for stocks, particularly in the banking sector and in the consumer sector, which I think will kick in later in the year. So if I had to sequence my investments in India, I would say I would still have a bias towards fixed income in the early stages of the year, but then rotate into equities in the course of the year.
Okay, that's good to hear if you like both pillars. But the Nifty at the moment is pretty close to its Brexit Day low of 7920, just about 100 points higher. How much more of a downside do you see at all? Do we get to 7,600, 7,500?
I don't see a lot of downside here. Remember that there have been some cold winds blowing through emerging markets in the fourth quarter, mainly for reasons that have nothing to do with emerging markets themselves. Trump's election has won, the Fed hike in the United States, the Italian referendum, ECB tapering, and of course the usual year-end position squaring, this tendency for markets to sort of reduce exposure as we get towards the end of the year. But as we start next year, a lot of investors are going to be allocating funds, and many of these funds are going to go into emerging markets, because emerging markets have actually performed quite well in 2016, particularly in fixed income. So I expect to see positive flows back into EM, including into Indian markets, at the beginning of 2017, which of course is not very far away.
FIIs have sold more Indian debt than they have sold of equities. Do you see them coming back into the Indian debt market, at least in 2017?
Yes, I do. And I think in general, I would say that the fixed income proposition is stronger than the equity proposition, mainly because the US equity market has run up a very, very long way, and because the dollar has become very strong. When you look at the yields on offer in India, as well as in other emerging market countries, they're currently extremely attractive compared to those you can get in developed markets. So I think we're going to see flows out of developed market fixed income into two areas, into US equities and into emerging market fixed income. After all, investors will have to have some fixed income. They're going to make losses in developed markets, but so they're better off having emerging market fixed income, and that should benefit Indian bonds as well.
Okay, that'll be good to hear. We'll have a salutary impact on our yields. But let me come to the stock markets and to some specific stocks. Some of the much-loved consumer discretionary stocks, like, say, Asian Paints, Eicher Motors, have fallen nearly 30% from their 2016 highs. Do you think these stocks represent value to you now?
Yeah, consumer discretionary, I think, is a good play. If you are a little bit more longer term, in the short term, I think I would still be a little bit more cautious as we see the uncertainty surrounding Trump's policies and the final ramifications of demonetisation play out over the next couple of months. But if you can look beyond that, I think you definitely want to take exposure to the cyclical side of the economy. That's consumer discretionary as well as banks.
I'm very interested to know what your thoughts are on banks. In fact, are you buying any of them, or even the non-bank financial companies which have now started to recover a bit?
I like the private banks. I think that's where there's most upside in response to a cyclical upturn. We still need to see more work done on the public sector banks. I think there may be room if Modi's political capital picks up after the demonetisation setback. I think there may be political capital at some point next year to begin to deal more with the public sector banks, but I don't think they're cheap enough yet to warrant buying them. So I think private sector banks are the place to be, really.
Not cheap enough to be bought, public sector banks. Okay, in 2017, will the Nifty go past its prevailing all-time high of 9,000? Or if you just to rephrase, what kind of returns can you expect at an index level?
I'm expecting relatively modest gains for equities, but nevertheless double-digit returns. Somewhere between 10 and 15% should easily be achievable for 2017.